What an absolutely insane week last week was. My name is Hamilton. I'm here with the Trading Initiative, and this is this week's Markets in Focus. We are rolling into Q4. Today is October 1st. We are looking to trade the end of the year here. Is it going to be fundamentally different than Q3? We believe yes. All right, let's go ahead and start with intermarket analysis, and let's look at week over week change here. A lot of big moves. You have to be aware of what's going on in the market right now because these are historic type of moves. Look at the 30-year bond yield up 4% in a single week. The 10-year bond yield 3.24. This has caused massive pukes in the bond market, thus also weakness in the equities market. Right now, we are trading a positive correlation between equities and bonds. This is very important to understand because for the last, decade or plus, the bond and the equity market have been inversely correlated. Your typical 60-40 portfolio is no longer efficient. I actually just made a video about that about a week ago. I'll link it in the description below or click right here and watch it. We might be changing into an inflationary environment from a deflationary environment, and intermarket relationships are going to change. You need to know what it's like to be trading. After that, though, Bitcoin surprisingly closed up on the week 2%. So in a market of weakness, Bitcoin showed some relative strength. We believe that above 25K, this is still in play. We don't necessarily want to be adding long exposure until we're above 30, but above 25K, you got to give your hats off to Bitcoin. It is hanging in there with the best of them. Crude, again, up week over week. Last 3 months, up nearly 30%. We do think crude is going to chill for a little bit here, but there's no reason to believe that it's going to stop. We're going to look at a chart in a second. You're going to see what we mean by that. If you're not long energy stocks through Q4 with a rising oil, it doesn't make much sense to us. So we'll look at that in a second. Small caps finished green. So Q3, specifically the last 2 months, have been notoriously very hard trading. But is there light at the end of the tunnel? We believe yes. We're going to go through that in a second. IWM, for the first time, closing green on a weekly basis. Congratulations. The Qs, closing green on a weekly basis. A lot of stocks underneath the surface really hurting here, but the big boys are starting to catch a bid. This is different over the last 2 months. This is different, right? So catch the clues early, start to build that Q4 playbook out. The rest of the assets, though, just crushed, specifically TLT, your long dated bonds. We are hitting historic lows. We're going to look at this in a second on the chart. It's really mind-blowing. And the crazy thing is, generally speaking, these should be buying opportunities. We're hitting generational lows in the bond market. Shouldn't you be buying? Actually, we're not sure. According to the Commitment of Traders report that comes out every week, there are more net long speculators in TLT right now into all-time lows than ever before. As you're going to see, the volume on the weekly candle is the most ever, and these are continuing to puke. So if the 30-year yield is going to continue to rise and TLT already has a record number of people going long, who's going to actually be able to buy the bottom? Are these guys going to be capitulating at the bottom, puking as bonds hit new historic lows? Who's going to be there to buy? The people that are sitting there patiently waiting to buy these things. Hopefully that's us. We are waiting to continue to buy TLT. You'll see that in a second. But in a market that has been notoriously very difficult to trade from the long side and short side over the last 2 months, there is a light at the end of the tunnel. For example, small caps. So let's go ahead and look at quarter to date because we are wrapping up the quarter, right? Let's look at quarter to date data here. Let's go back 3 months, and realistically, the theme in Q3 was energy. There's no reason for us to expect that to change anytime soon. As long as crude is catching a bid, as long as energy stocks are outperforming everything else, there's no reason for us to deviate from that core idea that energy stocks are going to continue to outperform on a relative basis. Also on an absolute basis, XLE is trading up near 14-year highs. But once again, I want to point out that there's a light at the end of the tunnel. You're looking at the 3-month normalized performance here, and obviously a lot of sectors are down a lot against the S&P 500, and they're down just an absolute value as well. Tech down, consumer discretionary down, comms down, but still trading above SPY, your Googles, your Metas, etc. When we niche this down to the 5-day, though, which is we're rolling into Q4, and this matters. We want to get the entire quarter in perspective, that 3-month chart, but what happened at the very end of the quarter? The last 2 or 3 days, the end of the quarter, notoriously dictates which direction Q4 is going to go. You see ETF inflows, all of the cash circulating the market. Where do they want to start getting long through this Q4 positive seasonality trend that supposedly is happening? We saw pop-ups in tech. We saw pop-ups in communications. We saw pop-ups in consumer discretionary over the last 3 trading sessions heading into Q4. We think that matters. That is a clue for us to potentially start looking at the names in the growth space that held up relatively well over the last 2 months. And that's what we're going to do inside of TTI. That's a hint for you. Look at the names that held up the best on a relative basis. Maybe those are going to be your stock market leaders going through Q4. So that's your intermarket analysis, the quarter to date sectors idea here going into Q4. We still want to be long energy. We're looking to get long growth in names that showed relative strength. Let's go through a quick little new segment of top 3 stupid Twitter stuff. Or it doesn't have to be stupid, but at least top 3 Twitter things. First off, Mr. Timothy Sykes, I don't believe he actually believed this. People get paid off Twitter now, so they're going to post ridiculous crap. Get those clicks, get the engagement. But Timothy Sykes was just the first one that came up on when I just searched 1987. This was the prevailing hypothesis going back 2 weeks, that we were going to have this crazy 1987 style sell-off coming into last week, rolling into Q4, and we were just going to get this absolute capitulation in the S&P 500. And, it's just too bad. Timothy Sykes posted this, 73.6K views, but I mean, there were people that were getting like 1 million views with this same type of idea. Are we going to crash? You need to run for the hills. We're going to puke. Like everything is going to shit. And yeah, it didn't happen. Didn't happen at all. Matter of fact, we might have found a floor. So once again, not necessarily calling out Timothy Sykes. He's just the first one that popped up on my search. And like I said, I don't think he actually believes this. But when you see sensational headlines like this, always question the validity of the theory and try to validate it with some sort of back-end process that roots itself in price and not, fanatical emotional responses from people that want you to click on their shit so they get paid via advertising money, right? This stuff right here is so out of the fucking box. It's out of the realm of what you can expect that most people are going to start succumbing to this stuff and they're going to freak out and they're going to want to sell or they're going to want to short, when in reality, this is not rooted in reality whatsoever. It's just bullshit. And it didn't play out. So let's go back to the drawing board, FinTwit, doom and gloom guys, and let's cook up your next market ending scheme to get people to click on your shit. Let's go to Ryan Dietrich. Fantastic follow. Highly suggest at Ryan Dietrich. This is another chart that's been posted around. And I just want to talk really quick about this. Data is important. There are I'm an undergrad and a grad degree holder in economics. And, in my undergrad in particular, I had professors on one side of the aisle, professors on the other side of the aisle, and they could argue the exact same data point 2 completely different ways. And it really opened my eyes to this idea that the data itself is in the eye of the beholder. And so, for example, all of these negative data points are coming out where people are defaulting on their loans and doing this and doing that. My favorite one was we have historic levels of credit card debt. If you just read that headline, we have historic levels of credit card debt, you would say, well, yeah, we think that the market's probably going to crash soon. That's just absolutely not sustainable. But when you take the credit card debt and divide it by the disposable personal income, it's actually lower than it was pre-pandemic at just above 6%. It's actually lower now. So yes, we do have more credit card debt, but when it's divided by disposable personal income, so how much does that credit card debt actually impact us on a day-to-day basis? Well, not so much actually. This right here shows that the consumer, specifically with credit card debt, is in a lot better shape than we were 3 years ago before the COVID crash. So once again, trying to present a different type of focus point. When you read these sensational headlines, take a step back, understand if they have an agenda. Should you be looking at it a different way? Could you be looking at it a different way? If they want you to think bear, are they forcing some sort of data set to prove their point without giving you another opportunity to make your own opinion? I normally say yes. I try to dive into it. This is a great example. Credit card debt all-time high, but in regards to disposable personal income, it's not at all. It's actually very, very, very manageable. And the last thing here from Ryan Dietrich, once again, seasonality. So this was a big trend going back the last 3 weeks. Perma bulls are sitting there reaching for whatever they can to say, we don't want to short this market. This market's not going to fall back down, 20%. There's no way this was a big bear market rally over this last year. And the seasonality idea came in. Ryan Dietrich posted this. It's a great example of, yes, August and September are your 2 worst months in terms of the S&P 500 average return. October, November, December are, historically speaking, since 1950, the best. So if you are into this seasonality idea, the time to be buying, if you expect history to repeat itself again, is right now at the beginning of October. So pre-election years are a little bit weaker in October and November, but ramp up in December. If you want to take a political opinion on that, feel free. But realistically, going back 50 years, right, or back to 1950, not 50 years, October, November, December are your 3 most bullish months out of the entire trading year. And therefore, you can bake that into your trading strategy going in towards Q4. Okay, we expect this to respect the historical inflows. And we'll see, right? It's okay if it doesn't, but that's what we're looking for right now. So let's actually pull up some charts here and then we'll call it a session. Let's start with SPY, right? We're going to look at this on the weekly. Ugly candlestick, absolutely ugly candlestick. And like I said, with seasonality, we peaked in the end of July and we essentially potentially found a floor at the end of September, right? So that Q3 seasonality aspect of being the weakest months played out perfectly to a T. Do we get this Q4 pop? Potentially, right? It's not the prettiest candlestick, but it does show that buyers did step in and saved it from potentially capitulating down to like 420. Absolutely low on the week was 422.29. We stepped in, we as in buyers, right? I was a net buyer last week. We stepped in, tried to defend 430. We think that's the line in the sand, right? Before we start adding a lot of exposure long again, we want to wait for SPY to close above 430, and we were unable to do it. On the weekly, 427.48. But we're right there. We think it's a great opportunity for bulls to defend this level and start to pop back up, given Q4 historical returns. We just approved the government will not shut down, right? They have cash. They just approved the budget. And so we have a lot of bullish narratives going in towards Q4. We do expect 430 to hold as some sort of support and bounce here, but we want to respect risk. We don't want to continue to pump cash into the market if we're still trading below 430 because there's massive. I mean, this was a massive pivot level to this upside when we went long back in April or May of this year, right? This was a huge point of inflection. We don't want to start trading long when we're underneath it. It just completely destroys our analysis. And so we're patiently waiting to deploy a lot of capital above 430. We are cautiously optimistic that it'll happen. The Qs held up a little bit better, right? They had a lot more to fall, but they didn't. Like we said, a big tech, mega cap growth started catching a bid. We like that. We saw that reflected in the week over week analysis. We saw that reflected in the 5-day sector returns. Tech, communications, and consumer discretionary starting to catch a bid here. Do the Qs stamp out a low here on the weekly candlestick here, 351.36. Once again, line in the sand for us is 360, currently trading 358.27. So just like SPY, we're right underneath it. We're cautiously optimistic that it's going to hold, but we don't want to continue to commit capital if it doesn't. So we're cautiously optimistic heading into this next week with longs on our mind, but we're being very, very wary of that risk. And last chart here, which I think is the most important of the three indexes right now, is this IWM, your small caps. Over the last year and a half, we have done nothing. Small caps, the Russell has been range bound. Absolutely nothing. We've been pinned under the 200 and above, realistically, the 170 area. Where are we right now? On the weekly chart, we are bouncing off of that 172, 173 level and heading back up to the upside. That is good, but we're not out of the woodwork yet. Listen, for us to really want to get bullish, we want small caps to be participating. They don't necessarily need to be outperforming, but if you take this risk theory that small caps and micro caps are generally going to be bought at the very minimum, like I said, they don't need to be outperforming, but bought in risk-on environments, because obviously the potential returns on those are way higher than your mega caps generally are. This does not give us a whole lot of confidence that that environment is coming back yet. We want to see the IWM chart start hitting higher highs, and it just hasn't happened yet. Now, I did take a speculative position long IWM. It's targeting basically all of Q4. I believe it's a December expiry targeting 190. So I'm expecting IWM to catch a bid, but I don't know if it's going to break above the 200 again or not. Until IWM breaks above 200, it's hard to want to get really, really bullish on small caps. Micro caps, IWC also building a base along the bottom of this horizontal channel that we have here. We're cautiously optimistic that it's going to pop up through Q4, but once again, we don't want to continue to commit capital as long as it's hovering around support. This is just not the thing that we want to do. The most important chart, we believe, other than the bond chart, is the Dixie chart. We've been all over this. If you've been watching any of our content, if you're a technical trader, you have to look at this and think that this is a breakout. This is a breakout on a massive scale, right? Going back a year, we consolidated at the bottom of a downtrend here, and we're breaking back out. As long as the dollars continue to go up, we expect stocks to have a harder time also rallying. They can both go up, don't get me wrong, at the same time, but it's going to be very difficult for stocks to have a strong rally day over day, week over week, as long as the dollar is catching a bid. There's an inverse correlation right now between the dollar and the equity market. So if the dollar is going to continue to catch a bid, we have to expect that stocks are going to have a very, very hard time also catching a bid. So something to consider here. We did have a long in UUP. We did close it, UUP giving us exposure to this dollar long thesis, and then crude oil, right? So we've been long energy stocks for quite a while. We expect crude oil to continue. It's kind of the same chart as the dollar. Does it not look somewhat the same here? We had a rounded top, a breakdown, a rounded bottom, and a breakout. If you're a technical trader, this break above this 84 level, you have to assume it's going to continue to go up until it stops. And if you're not long energy stocks through Q4 with a raising oil price, I would be looking to potentially buy any dips here. It wouldn't surprise me to see oil kind of chill out. We have seen a crazy run here, and if it came back down and tested a previous resistance turn support, certainly within technical analysis, that makes sense. Is there a possibility that we could see $100 a barrel of $100 per barrel of oil this year? Yeah, absolutely. And if that's the case, what do you think happens to energy stocks, which are already pressing in towards their 14-year highs? I'll leave you to ponder that by yourself. Last chart here I want to point out, this is realistically, the most important chart in the market right now. The 30-year yield is absolutely breaking out. Technical trader, this is a consolidation phase. We're breaking out into new highs. How high can this go? How high can the 30-year yield go? I just made that video. Once again, linked in the description below. Check it out. Are we moving into an inflationary period where, the 30-year is going to potentially be maybe not going parabolic to the upside, but it will be moving up? And can stocks rally if the 30-year yield is going up? It's going to be a challenging environment. If you're a technical trader, you understand what a consolidation fractal and a breakout is, and this is a consolidation fractal and a breakout. If we look at TLT really quick, we are hitting historic lows, right? TLT being your 20-plus year bond. So this is directly correlated to your US 30-year yield. And we are almost at historic lows. We're almost at all-time lows here, right? And I just want to point out that, according to the Commitment of Traders report, speculators are very net long TLT, more so than at any point in history. And as a matter of fact, we just had the highest volume on the weekly candlesticks of all time. And we are still hitting new lows. We are still puking. There's no floor to be found here in TLT. My question is, if you want to take the bond trade, which we do eventually, we eventually want to buy the bond trade, where's the floor and how are we going to get there? If, speculators are already absolutely net long this and we are still puking, we believe there's going to be some sort of crazy event that absolutely causes the majority of longs that have been buying the dip to capitulate. Where the TLT bottom comes in, I have no idea, but you have to expect sub $80 is going to be get the hell out of TLT. You're going to see speculators that have been accumulating during this dip absolutely capitulate on their positions. We could see a very short-term flush and open up potentially some generational buying opportunities. That's what TTI is waiting for. We're waiting for that capitulation move in TLT to start going long. To be transparent, I did take a crack at TLT back at like $90. or $92. I'm currently underwater on that, but I refuse to enter any more capital until we see that capitulation candle. After seeing the COT report week over week and that people are continuing to buy this dip, I don't want to buy it with them. These speculators are very notoriously wrong. They're expecting to buy this dip and find a floor. I expect them to get taken out of the deep water and drowned, and I want to buy their bags, as they're fighting for survival. Guys, my name is Hamilton. I'm here with the Trading Initiative. This was our Markets in Focus wrapping up last week. Today is October 1st. I appreciate you guys. Please like and subscribe if you like this type of content. Leave comments and questions below. I'll do my best to answer them, and I'll catch you in the next video.